After starting this module, we shall be able to understand the meaning, nature, need, and types of working capital. You will also be able to understand the importance of working capital. We shall also learn the factors affecting working capital, the various approaches of financing current assets, highlight various dimensions of working capital, and elaborate the concept of operating cycles.
Working capital management involves management of three different types of assets: inventory, cash, and receivables. Inventory management involves maintenance of the inventory at the optimal level so that there is neither shortage of inventory nor there is surplus inventory in the company. There are various techniques for inventory management like EOQ analysis, ABC analysis, VED analysis, etc. Cash management involves maintaining the optimal balance of cash in the organization so that the company is neither sitting on idle cash nor is there cash deficiency at any point of time. Receivables management involves the effective and efficient management of receivables or debtors in an organization.
To begin with, let us first understand the meaning of working capital. It refers to the capital required to hold current assets by a company, that is, the capital required to perform day-to-day operations smoothly. There are two concepts of working capital: gross working capital and net working capital. Gross working capital includes the sum of all current assets, whereas net working capital includes sum of current assets less current liabilities. There are two types of working capital required by a company. One is the permanent working capital, which is the minimum amount required to hold current assets on a continuous basis. And the second one is fluctuating working capital, which keeps increasing or decreasing depending upon the level of activity of business. Permanent working capital is generally financed through long-term sources of finance, and fluctuating working capital is financed through short-term sources. We shall now discuss the importance of working capital. If a firm holds excess amount of working capital, it imposes very high opportunity cost on firms as the funds could be invested for some other productive purpose. And if the amount held is too short, it can cause stoppages in day-to-day operations of the firm. Thus, it is very important for a company to maintain adequate amount of working capital. It helps in smooth functioning of day-to-day business activities, which improves the solvency of the company. Firms will, thus, be in a position to make regular payments to suppliers, which would help in getting cash discounts and would also improve their goodwill. High solvency and goodwill helps in getting loans easily. In case of business crisis like depression, firms with adequate working capital have a greater chance of surviving. Such firms can also make use of good market conditions like lower price on bulk buying, using their funds, and they are in a position to pay regular dividends to investors, which enhances their image. Working capital requirements of a company may be affected by many factors. These can be broadly categorized into internal and external factors, which we'll discuss in detail. Let us first discuss the internal factors that affect the working capital requirement. These factors vary from company to company. The first is nature and size of the firm. Large firms require a greater amount of working capital than smaller firms. Similarly, manufacturing firms require greater amount in fixed assets and lesser in working capital than trading firms. A second factor is manufacturing policy of the firm. If the manufacturing policy is uniform, it requires a constant large amount of working capital, Whereas if it is seasonal, the requirement will keep changing. After this, we have the credit policy. If it is liberal, that is, more time is given to creditors for payments, then large working capital will be required. And if less time is given, the requirement will also be less. Similarly, if credit available from suppliers is for a large time, then requirement of working capital will be less, and vice versa. Next factor is the growth and expansion aspects of business. If the firm is going to grow or expand in near future, the working capital requirement increases. Then we have the dividend policy of the firm. If it pays high and regular dividends, then more cash will be required, and hence large working capital, and vice versa. Last is operational efficiency. Highly efficient firms utilize resources at minimum cost, and thus the requirement decreases as against less efficient firms.
The working capital requirement based on a number of internal factors also. These factors are nature and size of the business. Requirement of working capital is basically influenced by the nature and size of the business. A firm with larger size will need more working capital, whereas a small size firm will need less amount of working capital. Similarly, nature of business also affects the quantum of the working capital requirement. A manufacturing concern needs larger amount of working capital, whereas a trading, financial or public utility firm requires less amount of working capital. The manufacturing policy of the firm is another factor. It's an important factor to decide the working capital requirement. The production policy of any firm can be uniform or seasonal. The manufacturing cycle starts with the purchase of raw material and ends with the production of finished goods. Larger the manufacturing cycle and uniform the production policy, the larger will be the working capital requirement. Firm's credit policy. A firm following liberal credit policy will require larger amount of working capital, and for strict credit policy, less amount of working capital is required. Credit availability from suppliers. Working capital will also get affected by the credit given by the suppliers. If the firm is able to get credit on liberal terms, then less working capital will be required, and vice versa. Growth and expansion of business. There is a positive relationship between growth of business and working capital requirement. It means growing firms need additional funds on a continuous basis. The dividend policy of the company. If the company pays high amount of dividend to its shareholders, then it will drain its cash sources, and hence large amount of working capital is required for normal functioning of the business. But if the company is following a conservative dividend policy, then it will strengthen its working capital position. Operational efficiency. It means optimum utilization of firm's resources at minimum cost. Better utilization of firm's resources reduces the cost of capital and improves net profit margin, which may help in releasing greater funds for routine functioning of the business.
Apart from internal factors, certain external factors also affect the working capital requirements of firms. These factors prevail in the entire industry or economy, which affects all the firms in the same way. First is business fluctuations. That is, With the change in the business cycle, requirements of working capital will also change. During growth stage, requirement increases and during recession it goes down. After this, we have change in technology. Improved technology leads to a lesser requirement of working capital and vice versa. Import policy also affects the working capital requirement. As the imports are restricted, working capital becomes very fluctuating. Next are infrastructural facilities. If they are good, large production can take place, which requires greater working capital. The last factor is the tax policy imposed on firms. If the tax rate is too high, it leads to increased payments, which means higher working capital required, and vice versa.
The next factor is business fluctuations. Fluctuations in the economy also affect the working capital requirement in a company. For example, during economic boom, demand increases, which leads to increase in firms' inventory and debt level, and hence higher working capital requirement. Whereas in case of recession, sales fall and firms reduce short-term borrowings and hence less working capital requirement. Change in technology is another factor. Technological upgradation generally saves cost, which leads to a reduction in working capital requirement and vice versa. For example, installation of a new machinery with improved technology reduces the demand for labor, which reduces the cost and hence working capital requirement goes down. Import policy. Government's policy on import puts restrictions on the quantity of the imports and specifies time when the product can be imported, which alters the working capital requirement for the firms which use imported products as raw material or as semi-processed goods. Infrastructure facilities. If the infrastructure facilities are good in a firm, the production may take place at a large level. It increases the requirement for raw material and other current assets, which increases investment in working capital. Taxation policy. If the government imposes high taxes on firms, they are left with lesser amount to be invested in working capital. Therefore, firms' requirement for working capital investment increases. In case of liberalized tax policy, working capital requirement decreases.
After discussing the determinants of working capital, now we shall study the various sources of working capital financing. Basically, the sources are there, namely long term, which are for more than an year, for example, share capital, debentures, long term loans, etc. Short term sources, which are granted for less than an year, for example, short term loans, public deposits, etc. And spontaneous sources, which are not specifically taken but eventually arise in the course of business, like creditors, outstanding expenses, etc. A firm selects any of these three sources to finance its working capital. A firm generally follows any of three approaches in selecting these sources, namely hedging approach, conservative approach, and aggressive approach. In case of hedging or matching approach, as the name says, firms match the sources to finance an asset on the basis of their maturity. That is, for current assets, short-term sources are used and for fixed assets, long-term sources. In case of conservative approach, the firm tries to be safe against any unforeseen changes. Thus, it finances fixed as well as some of the current assets through long-term sources, and the rest of the current assets through short-term sources. Finally, in case of aggressive approach, the firm takes very high liquidity risk. It finances only some of the fixed assets through long-term sources. The balance fixed and current assets are financed using short-term sources.
There are three approaches for working capital financing. Hedging or matching approach. Under this approach, the life of the asset is matched with the life of the sources of finance. That is, fixed and permanent assets are financed using long-term financing and current and temporary assets using short-term financing. If long-term sources are used for current assets, the funds will remain idle and will cost very high. And if short-term sources are used for financing fixed assets, funds will be required to be raised repeatedly. However, exact matching is not possible in practical situations. Conservative approach. A conservative approach is one where more of the long-term financing is used than short-term financing. In this case, fixed assets as well as a part of current assets are financed through long-term sources. If the requirement of current assets increases,
However, selection of these approaches is not easy for a firm. It faces a risk-return trade-off in selection of these approaches. Selecting more long-term resources leads to high cost, that is, low return but less risk of liquidity. Similarly, having more of short-term sources gives more return, but it is very risky. Long-term resources should be there to provide safety and short-term sources should be used to provide high return. Thus, a balance has to be maintained between the two. We shall now discuss various aspects of working capital management. Basically, working capital management comprises of management of three different assets: inventory, cash, and receivables. Inventory management includes managing stocks at the optimum level with a view to avoid high cost of holding too large stock and stoppage in production by holding too short stock. Various techniques are used for this, like EOQ analysis, ABC analysis, VED analysis, just-in-time approach, etc. Similarly, cash management involves maintaining optimum level of cash in the firm. It involves taking credit for any shortages and investing any surplus amount as compared to the desired level. Finally, third aspect is receivables management. Higher debt allowance attracts customers towards firm, thus increases sales, but too much of it might expose the firm to a very high risk. Thus, receivable management involves maintaining optimum level of receivables to maintain a balance between the two.
working capital management is usually concerned with the administration of all the current assets and current liabilities. It involves determining the need for working capital, estimate the optimum level of investment in current assets. In working capital management, we have to strike a balance between risk and profitability without affecting the structural health of the firm. If the amount of working capital is high, the liquidity is high. But due to low capital turnover ratio, the profitability will also be low. Similarly, if the amount of working capital is less, a high turnover ratio indicates higher profitability, but liquidity may be seriously affected, causing loss of reputation in the short run. And structural health of the firm depends upon the amount of working capital. The various dimensions of working capital management are as follows. Inventory management. It refers to the managing inventory at the optimal level in the company. If stock level is too low, it can lead to stoppage in production process, and excessive investment in stock increases the opportunity cost and reduces profitability. Thus, an optimum level of stock has to be maintained as both the situations are not good for the efficient running of the company. Various techniques are also used for inventory management like economic order quantity or EOQ model, fixing stock levels, ABC technique, just-in-time or JIT approach, etc. Cash management. It refers to maintaining the optimum level of cash in a company. It includes managing checks, currency, drafts, bank deposits, and near cash assets such as marketable securities and time deposits in banks, as they can be converted into cash in a year's time. On the one hand, too low cash can lead to disruptions in making timely payments. And on the other hand, it is also important to use excess cash in some profitable way by investing in marketable securities. It is the most important area of working capital management as it is the basic denominator of all the current assets. Receivables management or credit management. Receivables arise when goods are sold on credit basis. On the one hand, providing credit facility boosts the sale by attracting customers and thus increases profitability. But on the other hand, chances of bad debts also increases with increasing debtors, which leads to high risk. Thus, receivables management is important to maintain an optimum balance of debtors, which increases profitability at an acceptable level of risk. Various ways can be used to reduce the bad debts by adopting strict credit policies, following collection procedures, etc.
We finally come to the concept of operating cycle. It refers to the time period in which a firm gets back the cash once it puts into purchase of raw materials. Once the raw materials are purchased, they are converted into WIP and then finished goods are sold to customers either on cash or credit. After some time, the cash is collected from debtors. Thus, it starts from purchase of raw materials and ends at receiving cash from buyers in case of manufacturing firms. However, in case of trading firms, it directly starts from purchasing of goods to be sold out. Thus, the length of operating cycle is shorter in case of trading firms than manufacturing firms.
It is a time duration required to convert sales after the conversion of input into output into cash. In case of manufacturing company, the operating cycle refers to the average time lapses which lapses between the acquisition of raw materials and final cash realization from sale of finished goods. Cash is used to buy raw material. So cash is converted into raw materials. Then the raw material and stores are issued to production department. Wages are paid and other expenses are incurred in the process, and work in progress comes into existence. Work in progress becomes finished goods. Finished goods are sold to customer on credit basis. In the course of time, these customers pay cash for the goods purchased by them and cash is retrieved and the cycle is completed. Thus, it consists of 4 stages: the raw material and stores inventory stage, the work in progress stage, the finished goods inventory stage, and the receivable stage. In case of trading firms, the operating cycle will include the length of the time required to convert cash into inventories, inventories into accounts receivables, and accounts receivables into cash. In case of financial concerns, the operating cycle will only include the length of the time required to convert account receivables into cash.
Thus, operating cycle includes converting cash to inventories and debtors to cash. The length of operating cycle is the sum of inventory conversion period and debtors conversion period. Inventory conversion period is further equal to the sum of raw material conversion period, work in progress conversion period, and finished goods conversion period. Now, we shall proceed to understand how these ratios can be calculated. First is the raw material conversion period, which is the average time taken to convert cash into raw materials. It is the ratio of average inventory of raw materials and average consumption of raw materials per day. Second ratio is work in progress conversion period, which is the average time taken to convert raw materials into semi-finished goods or WIP. It is calculated as the ratio of average inventory of WIP to average cost of production per day. Third ratio is finished goods conversion period. It is the average time taken to convert semi-finished goods into finished goods. It is given as the ratio of average inventory of finished goods to average cost of sales per day. The last ratio is debtors conversion period, which means the average time taken to convert debtors into cash. It is the ratio of average trade debtors to average credit sales per day. Cash conversion cycle is another aspect of operating cycle only. It is the time period between converting inventories to cash through sales. Thus, it does not involve buying of inventories. It starts from converting inventories to sales and sales to cash. Cash conversion cycle is equal to operating cycle-less creditors deferral period. Credit deferral period is the average time taken by a firm to make payments to creditors. Thus, firms don't need to pay cash immediately to suppliers. It reduces the length of operating cycle. Creditors' deferral period is calculated as the ratio of average trade creditors to average credit purchases per day. Let us now summarize what we have learnt in this module. In this module, we have studied the working capital, which is the capital needed to hold current assets by a firm. It is of two types, permanent and fluctuating. It is very important for a firm to maintain adequate level of working capital as the excess amount may lead to higher opportunity cost and shortage may lead to stoppage in operational activities. The working capital requirement does not remain constant. It varies on the basis of many factors, which are mainly internal and external factors. Internal factors include size of the firm, nature of the business, etc. And external factors include business cycle, import policy, tax policy, etc. The funds for working capital may be obtained through various sources like short-term and long-term. Firms follow different approaches to select these sources. These approaches are hedging, conservative, and aggressive approach. However, firms always face a risk-return trade-off while selecting any source. We have also discussed the various dimensions of working capital management, which includes cash management, inventory management, and receivables management. Working capital also has another aspect, which is called operating cycle. Operating cycle is the length of period which starts from converting cash to raw materials and ends at conversion of receivables to cash.